And Reed for the great presentations and for all those who participants. They're really interesting. I'm definitely going to touch on some topics that were my goal for this presentation is to provide some cool information that allows everyone a good introduction into private equity. But I know that some of you are less experienced than others, so I designed this to try and be as inclusive as possible. So before diving in, I just want to give some brief personal background. I figured that would be helpful, especially if any of you guys want to network, hit me up, or have any questions that are career related or whatever. I'm always happy to help. And so I'm a finance major, psychology minor, graduating in this my last term, hopefully, if I don't fail anything. And so down the road, I want to work for a couple of years. I had an internship at a commercial real estate firm called LL, and I'm hoping that comes through. I have an email that I'll be receiving the next couple of days that confirms whether or not that happens. I'm sure a lot of you are in this similar boat. And then after that, I'll be transitioning hopefully to an MBA program and then pivoting into realm of private equity or management consulting, depending on what offers I can get, and hopefully long-term doing some philanthropy work to combat global poverty. Anyways, dive into today's plan. I'm going to do a general overview of equity for about 10 to 12, maybe a little bit longer minutes, and then I'll be transitioning to briefly talking about the big players in the industry, and then some of the recent industry trends, the COVID-19 outlook, and wrapping up with a quick conclusion before we jump on to Q&A. So private equity typically refers to investment funds generally organized limited partnerships that buy and restructure companies that are not publicly traded. Although private equity is strictly speaking an alternative asset class that deals with equity securities in operating companies that are not publicly traded, it's also used to describe the process of taking a public company into private ownership in order to restructure it before selling it again at a hoped-for profit. So broad industry that has a lot of different services and ways of operating. Ashley and Reed talked about venture capital and angel investing, and they certainly all lead into each other. We did talk about the distinctions in earlier discussions. I'm not going to go into that too much. And private equity is a global industry. It's composed of many firms. There's literally thousands of firms around the world that have different established funds and many investors whom are all ultimately seeking to strengthen businesses and generate the possible returns for their investments. So private equity firms are a relatively new beast in the capitalist zoo. However, many companies that are not traditionally thought of as private equity firms actually have many of the same techniques. A good example of this is Warren Buffett's Berkshire Hathaway, which is just a huge global conglomerate that's acquired many companies over the years of its operations. And the methods that private equity firms employ, such as venture capital or distressed takeovers or leveraged buyouts, and others are as old as capitalism itself. So, for example, you can think about joint stock companies of the British North American colonies, which were provided with capital from rich merchants in England. So this is way back into the early late 1600s. Moving forward, you can think about the 1890s when the railroads were prolific, when J.P. Morgan intervened with distressed railroad enterprises and took control and rationalized their capital structures and often provided new and competent management. So pretty popular private equity practices. Debatably, one of the first leveraged buyouts was actually in 1901 when J.P. Morgan and Co. Bought out Carnegie Steel and made Andrew Carnegie the richest person in the world at the time. They bought it for $430 million, which in today's world doesn't sound like a ton. Like the most rich for the wealthiest in the world, but back then $430 million was a lot. Anyways, a lot of these acts actually contributed towards the Glass-Steagall Act in 1933 Congress passed, which basically just gave the power of the Fed to regulate retail banks, and it separated commercial and investment banking. So some of the first private equity firms that we officially refer to are firms like American Research and Development Corporation and J.H. Whitney, which popped up after World War II in 1946. There was a few other firms that popped up as well in this time period, but their private equity firms didn't really become super popular until the late 1970s, and especially in the 1980s. So 1970s, venture capitalists, which is sort of an arm of private equity that Ashland talked about, really propelled Silicon Valley, the whole development that occurred there in California. And in the 1980s, they became notoriously popular for the huge profits, huge losses, and also some scandals. One of the most famous scandals was Ivan Boesky, who was caught insider trading. He faced prison time and like $100 million fine. But with that said, the majority of private equity firms and professionals have not been involved in any known scandals, and despite their industry's reputation being slightly tarnished in the media by popular cases like Boesky's, they've been a huge force in innovations and were like a huge driver behind the technological revolution, which was unleashed by the microprocessor, and they've been involved in propelling the fast-paced, innovative global business environment ever since. So in the 1980s, just to talk a little bit about the growth of the industry, in the 1980s, there was just a few hundred firms. Now there's over 8,500. So yeah, moving forward, private equity has a huge impact on society. As I was just talking about, it's really been a propellant of innovation and growth. And one of the really interesting things that I discovered through my research for this presentation was impact investing. And this is partly a byproduct of the stakeholder movement, where pressures have grown on fund managers to incorporate environmental and social issues in their investment decisions. So this is a super cool facet of private equity. It's become known to like it started to take off in like the last couple of years, decades, I should say. And a recent report that I read from Bain Capital showed that nearly 80% of global investors today focus more on sustainability now than they did. Because if you think about all the managers out there and global investors, that's 80% is quite significant. So anyways, this Bain Capital report synthesized over like 2,000 studies, which showed a strong correlation between the performance of environmental, social, and governance, known as ESG funds, and positive investment returns. So it's been proven that investing in the environment and causes like climate change or plastics pollution, deforestation, or investing in acts of justice, like social inequalities and who can't even access water, do have real world applications, but also generate positive returns. So they're win-win for society and win-win for private equity investors. So anyways, beyond impact investing, private equity also serves to help companies who are in desperate need for capital. As I touched on earlier and will continue to highlight throughout this presentation, private equity is certainly a means to generate massive returns. But like other investment vehicles that are known to do that, there's also, as Rick describes in his classes, return and risk are two sides of the same coin. So with high returns comes high risk. And private equity investors have to partake in a huge appetite for risk. And it's also relatively illiquid. So if things do go south, there's not much that they can do to get out of a deal if they've already invested in one. Anyways, so private equity is massive. It touches virtually all industries. And private equity firms target funds that are specific companies based off their life cycles, and they take great precaution in doing so. So young firms, as you see right here, are startups with high growth and perspective and promising management teams. So Ashley and Reed talked a lot about firms in these stages. And then on the road, in the business cycle, so sort of this two that you see on the right hand or on the left hand side, and right on the right hand side, established companies. So these are predominantly known as leveraged buyouts, and this is really the most popular area of private equity, the most notorious area of private equity, and this is what I'm going to be focusing on for the majority of the remainder of this presentation. And also, private equity firms have more recently become interested in investing in distressed companies, and this has become more popular after the 2008 financial crisis, where there's like a huge sprout in Chapter 11 bankruptcy filings. And so private equity investors' main firms' main goal in doing so was basically to get in cheap and turn the companies around by changing around management or operations, or simply just buying and selling off their assets. These could physical machinery, for example, or real estate or intellectual property like patents, and then basically whatever enables them to turn a profit for distressed companies. So as I said, I'm going to really focus on the leveraged buyout. I could talk about venture capital, but I think Ashwin did a great job. And anyways, distressed companies, I just talked about a little bit, but leveraged buyouts are really the meat of private equity. And so I thought this example was pretty good because it really broke down and simplified what a leveraged buyout is. And it would allow those of you who aren't super familiar with this whole arena to get your hands a little bit dirty and get some experience of thinking in terms of a private equity analyst or firm or associate. So a leveraged buyout is the acquisition of a controlling interest in another company, which uses a significant amount of borrowed money to do so. This is known as debt. So the assets of the target company, which is the company being acquired, in this example, that would be Antonio's nut house, are often used as collateral for the loans, which is, for those of you that don't know, means of debt, and as well as the company, so as well as the collateral of the acquiring company, so the assets that the acquiring company puts on the table. So banks want to make sure in most cases that their backs are covered. Now there is different levels of debt and different types of debt that can be used in leveraged buyouts. I'll touch on that a little bit, but it can get complicated fast, and I'm trying to be as inclusive as possible in this presentation, so I'm not going to dive too deep into that area. But anyways, a key feature of the leveraged buyout is that borrowing takes place at the company level, so it's not with a private equity firm. In other words, the company that is being bought out, in this case, Antonio's nut house, essentially borrows money to pay out the former owner. So Antonio, the former owner, is selling his business. It's generating $1 million in profit a year. He's looking to sell the company for $5 million. So Alpine Investors, a private equity firm, gives him $2 million in cash in return for 100% of Antonio's stock. And they also obtained a $3 million loan, which is, and Antonio's nut house obtains a $3 million loan from Bank of America. And they sign a promissory note, which basically says that they will pay back that amount at a certain point. Okay, so I think I covered sort of the basics of a leveraged buyout. If anyone has any questions, please feel free to ask so. And I just wanted to talk about the impact of leverage a little bit. And also, just to go back quickly, I'll talk about sort of one of the biggest leverage buyouts that's ever happened. And I thought that this was a pretty cool example. So in the period between 2005 and 2007, this sort of a period known for its mega buyouts. And the biggest one was a $48 billion acquisition of the largest utility or electricity utility companies in Texas, known as TXU. And it was acquired by a consortium that was led by Colbert Kravis, Roberts, Texas Pacific Group, and Goldman Sachs. So the deal was really based on the belief that rising demand for energy would stretch supply and push up electricity prices. But shortly after the deal was completed, increasing horizontal drilling, also known as fracking, led the U.S. shale. It led the U.S. shale sort of movement and revolution, and energy prices tumbled as a result. So the new company that was formed, Energy Future Holdings, which was originally TXU, basically was forced into bankruptcy, and it qualified for one of the top 10 biggest non-financial bankruptcies in history. As I mentioned earlier, Warren Buffett, who many of you know, was convinced that this deal could not miss out, and he ended up losing $900 million because he got in on it as well. So anyways, I ultimately chose to use this example before moving forward because I really thought that it shows that LBOs can be rewarding at times, but as this example points out, extremely risky. And no matter how many investment resources any individual or firm has at their disposal or how experienced of an investor you are, you do have to factor in the fact that you can be wrong sometimes and pay the consequences for doing so financially. Okay. See.
Can I ask a question?
So for those of you who are active traders and utilize margin accounts, you probably are familiar with the concept of leverage.
Hayden?
Yeah.
I think we have a question that someone was trying to ask.
Oh, totally.
Yeah. So when the bank gives a loan or buys out the previous CEO or whatever, and they use the assets as collateral for the loan, does the assets value have to match the loan value, or am I just misunderstanding that? Because it seems like a bank would only give as much as the tangible liquid assets that the company has,
Yeah, that's a really good question. And I think it has to do, there's a lot of underlying factors, such as what type of loan it is. But you're right, banks do want to protect their backs and they don't want to take on huge risks. So it also has to do with the credibility of the business, the investors they're going into the deal with, and a lot of other factors. So it's kind of case by case dependent, but in sort of these fixed bank loans, I think they're known as like trade bonds or some trade debt or something like that. Typically the collateral does have to have a significant weight on the loss potential. But Rick, if there's more, or John's, please jump in.
Yeah, so you're right, Hayden. The loan and what's backing it up have to have some kind of relationship. More often than not, though, some of these companies that are receiving loans have little in the way of physical assets to use as tangible collateral. Very often it's their customer list or their technology or their patents. And so what really stands behind this as collateral is typically the entirety of the firm. And these amounts are not going to equal each other. If there's a $10 million loan, the bank doesn't want to see $10 million in value for the firm. The bank wants to see much more than that because they're going to cover their bases in a very healthy way.
Real quick, so I work for not a bank, but it's a small credit union. But we we do have the ability to lend to many businesses. Something that I've noticed is the way we look at those loans specifically are, like Rick was talking about, just the potential of paying it back. I've seen people come in and they have a sole proprietorship and they're just starting out, and they get approved for loans big enough to get them an office space. For example, it could be up to 700,000, which was very interesting for me, at least, because I didn't think that businesses like that could get approved for such a high amount, especially since they're just starting out. So they tend to just look at the person or individuals that can come up with enough income to pay back at a certain time. However, again, like Rick was saying, they want to see the potential to pay all of that plus all the other obligations. So it really varies on the potential of the business, and banks and credit unions like mine have, they really do try to look at the potential earnings for the company.
Well, and when we're dealing in the private equity space, rarely are we going to be looking at loans in the $700,000, million, $2 million, $3 million, $5 million even. Typically, the loans are going to be in the tens of or hundreds of millions, in which case we're going to go way beyond looking for personal guarantees from the founders or the principals of the firm. We're looking at a scale issue here that's significant.
Totally. That was a really good question. Thanks for asking that, and cool discussion that followed up with it. So I guess I want to keep moving forward. I do have some more things to cover, but please feel free to intervene at any time. And we can do a Q&A at the end as well in case you think of anything after I already go through that section of the presentation. But anyway, moving forward, I want to talk a little about the impact of leverage and sort of what makes the LBO what it is. Again, an LBO is a leveraged buyout transaction. So if you look at the second and third columns, so this in this slide, you'll see that the value of debt holds constant. The private equity firm increases their equity value by increasing the enterprise value of the company. So in other words, utilizing leverage in financing this deal with debt allows them to reap a higher return on their initial investment. But on the contrary, in the fourth column that you guys can see, the company faces a higher risk of losing their equity value at a faster rate if their enterprise value decreases. So this goes to show that private equity firms are in the business of increasing the value of their companies in order to generate those high returns. And if they aren't able to do so, they can really find themselves in a difficult predicament. So anyways, I thought this was a cool slide that showed that leverage is a double-edged sword. It increases returns, but it also increases risk. As you can see, a 20% growth in enterprise value results in a 50% growth in Alpine's equity return, but a 40% decline in enterprise value, as shown in the fourth column over here, results in 100% loss in their equity value. So anyways, I thought that was pretty cool. And I do want to mention the fact that in a lot of private equity deals, the leverage or the debt to equity ratio is actually a lot higher. It's been seen to go up to like 9-to-1, so 90% debt to 10% equity. So these firms are taking on a huge appetite of risk to really try and generate a strong alpha, which is basically just like a massive return compared to their market benchmark or industry thresholds. Okay, so I'm going to move forward. So private equity investors. So these were mentioned in the two previous presentations. So I'm just going to fly through these. If any of you guys have any confusion, feel free to stop me, but I want to keep moving forward. So accredited individuals are basically an accredited investor with a net worth greater than $1 million, or someone who has a annual income that exceeds $200,000 a year, or joint income with their spouse exceeding $300,000 a year. And that has to be true for the 2 years before entering into any sort of deal. Pension funds, basically funds that help pay for workers' retirements, university endowments, or money or other financial assets that are donated to universities or colleges, and they're meant to grow principal and add additional income for future expenditures and investments of any particular school. One really well-known investor that I just want to point out in case you guys want to do some research after this is David Swenson, and he's in charge of the Yale Endowment, considered one of the best investors of all time. He has some cool strategies about like an all-weather portfolio. Anyways, to stay on track, charitable foundations, so like the Bill and Melinda Gates Foundation, for example, the Rockefeller Foundations, United Way. Anyway, I think most of you guys know what charitable foundations are. And then other institutional investors, which are just like banks, credit unions, insurance companies, etc. So these are all people that can get involved in private equity. But the point is that there are barriers to entry. It's not for the common individual who doesn't know much about investing or finance. And that's because of the huge amounts of risk. And also just kind of the way that private equity works, the connections and so forth. Okay, so moving forward, private equity firms usually have, as I just said, like an extensive contact list, C-level relationships such as CEOs and CFOs within a given industry, and they may also have partners or other skilled employees who are experts in realizing operational efficiencies and synergies. So all these are attributes that have potential to add huge amounts of value to a given business. So private equity firms typically employ a buy, build, sell model. With that said, they're looking for ways to make their equity stakes more valuable when they end up exiting. So when thinking about that, private equity firms and investors are primarily focused on making great purchases, because if they can get a better purchasing price, chances are they'll be able to generate a better return. So that's something worth thinking about. And so private equity firms typically like employ advisor service because, sorry, I was in the wrong slide. Private equity firms typically employ advisor services because it's typically in their best interest to do so. And they're really looking for like distinctive ways to achieve continued success by devising like differentiated strategies, routing or substituting management, investing in new technologies and intelligences, improving organizational design and decision making, or enlisting top talent, hiring and firing of employees, and also financial engineering, which is like bolstering or solidifying a firm's balance sheet. So those are some of the ways that they can make a company look more attractive. They're flipping it on the tail end of the deal, and often do. So moving forward, sorry, this is the slide I skipped to without realizing. But limited partnership is sort of the typical private equity firm structure. So it involves like a general partner, which is like the manager of the fund, and they target like a company portfolio selection as well as do post-investment advisory. And as you can see on the right-hand side of this slide, sort of the compensation breakdown of how these private equity firms make their money. So general partners typically receive 2% of the invested capital regardless of the fund performance. And 20% of the gross profits upon sale of the company, assuming they can flip it for more value than what they bought in for. And typically they contribute about 1 to 3% of the investment size, whereas limited partners, who are the rest of the investors that are giving their money to the general partner to select different target companies, they make the rest of the fund, so 97 to 99% of the investment size. And this hurdle rate is basically just the minimum rate of return that GP has to meet in order to receive their carried interest, and 8%, I believe, is the industry average, if I'm not mistaken. So if anyone has any questions on that, I'm happy to answer them, but I'm going to keep moving forward. So I thought that this visual did a good job of sort of just like breaking down the private equity process. So as you can see on the right, like the middle right hand of the slide, the formation phase is sort of the first phase of the process. So it takes place in the beginning and typically takes 2 months to 3 years for funds to be collected. So the duration of this largely depends on the reputation of the management firm and the demand for their services within the investment community. And once they get the funds, management makes the decisions on if they want to specialize in a certain industry, market, etc. And it's important to state that they often do, more often than not. So moving into the second phase, on the left-hand side, you can see the investment phase, which typically has like a 5-year life cycle. Now, this varies quite a bit, sort of depending on the case-by-case scenario, but to simplify, it's just the identification of target companies, the optimization of sort of the mix of the portfolio companies within a given fund that a firm manages, and then it can include the hands-on advisory services and other stuff that I talked about previously, which is meant to improve the value of the investments. And then the last phase is the divestiture phase, and this can take up to 5 years to find the right time and conditions to deploy the optimal exit strategy. It depends a lot on factors like the general state of the economy or the market volatility at a given time, or finding and qualifying the right buyer who's willing to pay the right price. So this goes back to that concept that private equity firms really do want to get the appropriate returns, which is typically the required return that's being demanded by the bulk of their investors. And it's a win-win for everyone in that situation, for the private equity firm and all their investors. And they really do want to find the right seller or the right buyer so they can get that price they're looking for. So private equity, as many of you know, is a super attractive field. It's intellectually stimulating. It's very dynamic from an employee perspective. It's a super intense work atmosphere that involves many important roles with huge responsibilities, and it's highly lucrative and highly competitive. It's considered the best of the best, sort of the pinnacle of many of the financial professions. Many bankers pivot to private equity after a few years or decades in investment banking, and it's a good place if you can make it. Anyway, so just to give a quick example of how lucrative it really is if you're an employee, the firm has $1 billion in assets under management. The majority of private equity firms, likely to have no more than a dozen investment professionals. Private equity firms, in this example, is pretty small. Now that does change depending on the firm, but we'll get into that later. And 10% of gross profits generates millions in firm fees. As a result, some of the leading players in the investment industry are attracted to positions in such firms. At a mid-market level of 50 to 500 million in deal values, associate positions are likely to bring salaries in the low six figures. A vice president at such a firm could potentially earn close to 5,000 to $500,000, and a principal or partner could earn more than $1 million. Now, depending on the firm, depending on the deal, depending on what's going on, that can change. Typically, it goes up. I was reading about some deals where principals and partners made tens of millions of dollars on a given deal. So that's just to give you guys an idea of why it's such an attractive field for for a lot of financial professionals. So some major players in the private equity space, over time, the biggest players have tended to go public. So one of the questions that was asked earlier was, about like what is an IPO. So an IPO is what happened to firms like Blackstone and the Carlyle Group. And I was gonna go to their websites, but I assume you guys can do that later if you want to and are interested in doing so. For the sake of time, I'm gonna keep moving forward. PG is an interesting firm, and they have a lot of stuff on their impact fund, which is like goes back to impact investing, which I touched earlier. And I would highly recommend checking it out if you're interested in all the space. So to transition back into this, I was just getting into the industry trends of private equity, and so this was a report that Bain produced, which I thought was really interesting and was pretty clear compared to some of the other reports I read, which has some pretty confusing charts on them. So this just sort of shows the upward trend of investments, exits, and fundraising in the private equity space. And despite the somber macroeconomic outlook, as you guys knew, last year it was the longest bull market we've ever seen, and people were expecting a recession to come at some point in the near future. No one really knew when. But anyways, we can see that private equity activity didn't really slow that much despite those projections. So moving forward, one of the cool things that I found in this report was these charts, which showed the high multiples that private equity firms are willing to pay to acquire or buy out any given target company. So the average multiple of enterprise value to EBITDA for a leveraged buyout reached 11.5 times in the US and 10.9 times in Europe. So for those of you who don't know too much about multiples, that's pretty high, and it speaks to the large amount of growth that private equity firms are looking for. So high multiples are typical in high growth industries like biotech. I think Ashland talked about that a little bit. And then lower multiples are typical in like slow growth industries like railways. So this shows the IPOs were down while sponsor-to-sponsor deals and sales to strategic buyers kept pace. So these are the different deals that private equity firm, or these are the different exits that private equity firms can take. Some of the more popular ones, I should say. There's a lot of different strategies. But as you can see, IPOs were the second most popular, and strategic exits were the most popular, and sponsor deals were the third most popular. Or actually, I'm sorry, IPOs were the third most popular. Sponsor deals were the second most. But strategic exits were by far the most popular. And to just quickly detail what these exits actually are for those of you who don't know. So like a strategic exit is where a company you have invested in is sold to another suitable third party, such as an industry peer or a competitor, and then you take your share from the sale value. So this is commonly referred to as an M&A exit, so a merger and acquisition. And this is one of the most popular exit routes for private equity funds. And buyers who have a strategic advantage may be willing to pay more of a premium in this case, which goes back to the last slide with the high multiples. So a sponsor-to-sponsor deal or sale is a secondary sale where only the private investor will sell their stake in the business to another private equity firm. So this can happen for many reasons. For example, the business may require more money, which the current fund or current equity fund doesn't have the capacity at that period of time to have. And so another reason is that businesses may have reached a stage that the existing private equity investors wanted it to reach, and therefore they sell it to other equity investors who want to take it over from there. So lastly, an IPO. We talked about that a little bit in the discussion earlier, but just to briefly dive through it. An IPO is where the private equity firm sells its treasury shares to public investors with a sponsor concurrently selling pursuant to a secondary offering. So in most cases, private equity firms don't sell their shares to the public right after the time of public offering. Nicholas talked about the lockup period or lockdown period, and this is typically 6 to 12 months, which is a contract that's set at a predetermined amount of time. And it's ultimately meant to prevent like insiders from dishing out or liquidating their assets too quickly after a company goes public. So it's a tool that keeps supply from increasing at a disproportionate rate, which would ultimately have a consequence of driving down like share prices. So anyways, IPOs are in most cases accompanied by a listing on a stock exchange, and every IPO typically does not, in most IPOs, almost all IPOs typically do not result in a full exit for a private equity firm. And they can sometimes result in higher valuations for portfolio companies and other possible exits. So there is some attraction in the IPO space for private equity firms, but not as much as a strategic exit where they can unload all of their shares and equity holdings. Okay, so I want to talk a little bit about how the industry has changed. So as you know, global interest rates have dropped to extreme lows, and a result of that has been a capped superabundance, which has actually resulted in rates of return dropping. So there's easy capital and competition over buying assets, which sent prices soaring. So people are paying those higher multiples to get in to a private equity deal. And as a result, their IRR or their net IRR has dropped throughout the industry. So it used to be people were looking for 20% per annum IRRs, which is basically their internal rate of return. But now most people are content with 15%. But that being said, capital superabundance is actually, it's a double-edged sword because it can be good if you're selling at a higher price than you would be if there wasn't a capital superabundance. So I thought that was kind of interesting. Moving forward, one sec. Here we go. So this sort of breaks down the demand for alternative assets across the board. It kind of touches on both of the other presentations that we heard today, but it shows at the bottom in the red leverage buyouts, which in the past year were pretty substantial. So investors poured over $894 billion into private capital, which includes industries like private equity, real estate, infrastructure, natural resources. But the buyout class alone, which is that red that you see, raised $361 billion. So over a third of these global private fund types. So yeah, I'm just going to keep moving forward just for the sake of time. That's an interesting visual for you to sort of see how private equity dominates the alternative asset class space. Okay, so for many experienced investors, a crisis is not uncharted territory. So private equity people are pretty experienced. However, the COVID-19 outbreak is fundamentally unique in its disruption of core working processes, and private equity firms and their portfolio companies have come into the crisis riding a decade-long wave of transaction volumes, valuations, and fundraising. So many of them have been provided with a slight cushion heading into the COVID-19 epidemic, which has disrupted the economy in drastic ways. But like all industries, there are certainly fault lines in private equity. And these include the fact that deal leverage recently reached a new high as the multiples that were being paid. So people who just recently bought a target company may be a little bit worried right now, to say the least, as are most people, in terms of getting their return back. So anyway,
Hayden, that's probably a good place for us to break this.
Okay, yeah, that's my last slide. So
okay.
thank you for listening. Hope you guys enjoyed it, and happy to answer any questions.
Well, we'll go ahead and take our questions into maybe send them to Hayden by email, or we'll pick them up another time. We've only got a few more minutes before our class needs to be over, and I know some of you go into another class directly. So Hayden, thank you. Fred, you're kind of off the hook, so you can thank Hayden as well in terms of the discussant responsibility.